Okay, let's talk about foreign currency transactions and hedging foreign exchange risk. So if we're going to pay somebody in a foreign currency in the future or we're going to receive a foreign currency in the future, we've got a risk that that foreign currency is going to fluctuate in value between now and the time that we have to make our payment or receive our payment. And the basic rule is going to be that the underlying transaction has to be marked to market every time we prepare financial statements. So there may be a gain or a loss on that basic transaction. And if we decide to hedge it with a forward contract, which we'll talk about in a second, or an option, which we'll talk about in a second, that thing also has to get marked to market each time we do an income statement and a balance sheet. So let's look at our base case. We are an American company, so we sell something to a German company, and they agree to pay us 90 days from now, and they agree to pay us €1,000,000 at the spot rate. In other words, as of December 1st, as of the day we booked the sale, it takes $1.32 to buy €1. So we'll take those €1,000,000, if they gave them to us today, and turn them into $1,320,000. We'll book an account receivable, and to remind ourselves that we're going to get paid in euros, we'll put a euro sign out there. This number is $1,320,000. Every dollar on our income statement and our balance sheet is in American dollars. But we'll put this little euro sign to remind us that we're going to get paid in euros that we'll have to later convert to dollars. December 31st rolls around, and we have to prepare an income statement and a balance sheet. The spot rate has gone up. The foreign exchange rate has made the euro stronger, which is good news for us. My friend Jet says ARFs, and that reminds me that if I have an account receivable expressed in a foreign currency on my books, I want that foreign currency to get stronger, so that when I do get that foreign currency, it buys more US dollars. So remember our rule, the underlying transaction and any hedge, we'll get to hedges in a second, have to be on our books at fair value. So we write that account receivable up with a debit of $10,000, and we book a foreign exchange gain of $10,000 because the spot rate has gone up from 1.32 to 1.33 as of December 31st. So even though we haven't realized the gain yet, we book an unrealized gain of $10,000. Then March 1st comes, and we have to write our account receivable to market. The spot rate is down. The euro has become less valuable. It's gotten weaker. So we book a foreign exchange loss, and we reduce the account receivable. And what I'm going to do in this video is any income statement account is going to be in red font other than sales, so that we can see what's happening with all the foreign exchange gains and losses and things. Then they pay us. Let's use this account here called, it's a cash account called foreign currency euros. It tells us that we received some euros. We got a check, if you will, for €1,000,000 that equates to $1,300,000. That takes the account receivable off our books, and we turn that euros, those €1,000,000, into 1.3 million US dollars. So net, we've had a $20,000 loss, a $10,000 gain in year one, and a $30,000 loss in year two. Well, we may find that unacceptable. We may not want to have that kind of risk, so we're going to hedge ourselves. We're going to make other bets to protect ourselves. One mechanism would be to sign a forward contract. So we go to a bank and say, we're going to have €1,000,000 90 days from now. What kind of rate will you give us 90 days from now? And that's called the forward rate. If the interest rates of the foreign currency are lower, the forward rate is going to be higher than the spot rate. In this case, the euro rate is a little bit higher, so it trades at a discount to the spot rate, and the forward rate is 1.305. So we're willing to lock in the fact that we'll get $15,000 less just so we don't have to worry about things. So the first journal entry is the same. We know we're going to receive €1,000,000. The spot rate as of December 1st is still $1.32. So our best guess as to what we're going to receive is €1,000,000 that will convert into $1,320,000. There's nothing to book for the forward contract. It's an executory contract. And all we're doing is saying we'll exchange €1,000,000 with you for $1,305,000 US dollars 90 days from now. We get to December 31st, and it's time to mark the underlying transaction to market. The spot rate has gone up. When I have an account receivable designated in a foreign currency, I want it to get stronger, and that's what's happened here. So I've got that $10,000 FX gain. but now that contract has a liability attached to it. It's not such a good deal. Well, how do we find the fair value of a forward contract? We look at what kind of deal we would get at December 31st if we signed that forward contract then. Well, forward contracts are traded all the time. We can see on December 31st, if we had bought a forward contract, entered into a forward contract for euros on March 1st, what would the exchange rate be? And we discovered it would be 1.316. So that means if we had waited, we would have gotten an $11,000 more than we did by locking in on December 1st. But that's not going to happen for 2 months, so we've got to find the present value of that $11,000 to find out how bad a deal we got here. So we can go to our financial calculator, we can clear the third row, we can say that 2 is the N. If we're in a 12% per year borrowing market, that means that our incremental cost per month is 1%. And we've got $11,000 is the future value. Let's change the sign on that just so we'll get a positive number that spits out. And we'll compute PV, and we get $10,783. So that's the liability that's created by this forward contract as of December 31st. Okay, let's go to March 1st. The spot rate has gone the wrong direction as far as our underlying transaction goes. So we got to write that account receivable down by $30,000 and book a foreign exchange loss. That contract is now worth $5,000 because the spot rate may be $1.30, but we've locked in 1.305. So we're going to get an extra $5,000 above the spot rate because we locked in. So we've got to take that asset, we've got to create an asset where there was a liability. That liability had a balance of $10,783. To make it $5,000 asset, we're going to have to debit forward contract for $15,783, and we're going to have a gain on the forward contract. Again, the income statement accounts are in red. We received the check. The check is in euros, but it's worth 1.3 million. We take that check and we take it off our books when we turn it into US dollars. The contract rate is 1.305. To make that journal entry balance, we take the forward contract off our books with a $5,000 credit. And so now we've turned that million euros into 1,305,000 US dollars. So if you looked at all these numbers in red, you would discover that we end up losing like $15,000. And that makes sense. We locked in 1,305,000, and the original transaction would have netted us 1,320,000. But the timing's off a little bit. You look at this year, we've got a $10,000 gain and a $10,783 loss. So what we can do, the Mercedes-Benz of hedges, if you will, is the cash flow hedge. That allows us to match dollar for dollar the gains and losses on the underlying transaction. So I like to think of the cash flow hedge as using the accumulated other comprehensive income garage. Everything related to that hedge will first be stored in here and then brought out as we need it to match the dollars. And so what's going to happen is we're going to have to do things artificially that happen naturally when we used it as a fair value hedge. So we booked the same transaction just like we always have. We're going to get €1,000,000 at the December 1st, so the spot rate is 1.32. So we debit that accounts receivable and credit sale. At first the euro gets stronger, so as of December 31st we've got a $10,000 gain. We decided previously that that forward contract was a liability of $10,783, but instead of debiting a loss account here on forward contract, we store it in our garage. $10,783 gets stored in the garage. How many dollars do we need to bring out of the garage to match this $10,000 gain? $10,000. So we take $10,000 out of accumulated other comprehensive income and book it as the loss on the forward contract. And then since we're doing everything artificially, we're going to have to amortize that $15,000 discount. Remember, instead of getting $1,320,000, we've agreed that we'll get $1,305,000. So we find the effective rate of the transaction. Clear the third row. The transaction is 3 months. We were going to get $1,320,000 at the spot rate. That's the present value. Instead, we're going to get $1,305,000 by virtue of our forward contract. So we change the sign, make that the forward value, and then we compute the I, and we get 0.38. Since this is a calculator, that's in percent already, so it's 0.0038. And if you're using the 12th edition of Hoyle's Advanced Accounting, there's a mistake in there. The typo is it shouldn't be 1 minus the cube root of the present value, excuse me, the future value over the present value. It should be the cube root of the future value over the present value minus 1, and that's how you get this minus 0.0038. So we take that 0.0038, multiply it times the $15,000, and we write off 5,019. And even the advanced accounting book says that's a lot of work. Let's just use straight line from now on. So it's $15,000 over 3 months, $5,000 a month. March 1st comes along, the euro has gotten weaker, so we've got that $30,000 loss that we've talked about before. That forward contract is now an asset, so we have to increase it with a $15,783 debit. We don't book a gain. Instead, we put everything in the garage, so we credit accumulated other comprehensive income. How much do we need to pull out of the garage? $30,000. So we take $30,000 out of the AOCI garage and book $30,000 worth of gain. We amortize the last of that $15,000 discount, and in the future this will just be $10,000, $5,000 in 1 month, and then $10,000 for the next 2 months. We receive the euros, which at the spot rate are worth $1,300,000. Then we take those euros and we take them off our books, and we get $1,305,000 by virtue of the forward contract, and we take the forward contract off our books with a $5,000 credit. So a fair value hedge is just a fine hedge, but it's going to have timing problems. If we want to use the Mercedes-Benz of hedges, we'll use the cash flow hedge. At every balance sheet date, we'll mark the underlying transaction to market. We'll use AOCI to mark our hedge to market. We'll take whatever we need out of the garage, the AOCI garage, to offset whatever happened on the underlying transaction. And then on the forward contract, we should amortize using the effective interest rate. Now let's talk about using an option. And what we're going to do there is everything's pretty similar, except that when we're using a cash flow hedge, we'll book the change in time value, because eventually the time value of that option will be 0. So let's buy an option and treat it as a fair value hedge. So we book the sale just like we always have, and now we buy a foreign currency option that gives us the right, but not the obligation, on March 1st to sell 1 million euros for $1,320,000. In other words, the spot rate. How do we know how much that option costs? Well, the other party tells us. If you want to buy this option, it costs $9,000. We can buy it on an exchange, or maybe we have a single counterparty that we work with. Then December 31st comes, and just like before, the euro has moved in the right direction. We want it to get stronger. It has, so we've got a $10,000 gain. This is a fair value hedge, so let's mark that option to its fair value. Let's take a look at its intrinsic value and its time value to get a feel for its total value. Every option has 2 parts. The intrinsic value, is it a good deal or a bad deal right now? Well, our option was to sell these things at $1.32. There's no advantage to that. That's the market rate. So all that $9,000 value has to be the time value, the notion that there's 90 days and it could turn into a good deal or at some time over the next 90 days. So it's December 31st, and we find out that the total value of the option is $6,000. Well, since the intrinsic value is 0, it makes even less sense now to exercise that option, sell them for $1.32 when we can sell them for $1.33. So the intrinsic value must be 0. Since the fair value is $6,000, our counterparty tells us that. That means the time value must be $6,000. So we've got to write off the $3,000 as we go from $9,000 to $6,000. So that's what we're doing when we do a loss on foreign currency option. We reduce that on our books from $9,000 down to $6,000 value. So now we get to March 1st. The spot rate has gone down, so on the underlying transaction we've got a $30,000 loss. That option is now worth $20,000. The spot rate is $1.30, but we have an option to sell for $1.32, so that's an extra $20,000. That option was on our books for $6,000, So we've got to write it up by 14, and we've got a gain on foreign currency option. And so now we receive the $1,300,000 worth of euros, take that off our books, but we have the option to sell them for $1,320,000. So when we turn those euros that were on our books into US dollars, we get $1,320,000. How do we make that journal entry balance? Credit that option for $20,000. Remember, it was originally on our books for 9. We wrote it down to 6. Then we wrote it back up by 14 so that it would have a debit balance of 20. And now we'll take it off our balance with a credit of $20,000. So lastly, let's look at that option, but this time call it a cash flow option, the Mercedes-Benz of hedges, so that we can match up the timing differences dollar for dollar. Same entry here, book the sale. We've done that many times now. Put that foreign currency option on our books for $9,000 because that's what we paid for it. December 31st comes along. The euro's gotten stronger, so we have a $10,000 gain on the underlying transaction. That foreign currency option is down by $3,000 of value. Remember, it went from $9,000 to $6,000, but instead of booking a loss, we parked that $3,000 in the garage. We need $10,000 to come out of the garage to offset that $10,000 gain, so we reduce accumulated other comprehensive income, and we book a loss on foreign currency option. And then we have to take $3,000 out to recognize the expense that we're going to amortize that $9,000. We have to do artificially what happened automatically in the fair value option. So here's our $3,000, getting rid of or reducing the time value of that option. So we get to March 1st, we've got that $30,000 loss because the spot rate has gone down. So on the underlying transaction, we've got a $30,000 loss. The option is now worth $20,000, so it was on our books for 6 before. So we write it up by 14. We store that in other comprehensive income. We take out the $30,000 gain out of the garage to offset the $30,000 loss. We book $6,000 of amortization expense to get rid of the time value of that option, so that we're just left with the intrinsic value of the option, which is $20,000. And again, we're doing artificially what happened naturally when we treated it as a fair value hedge. We collect the €1,000,000 that are worth $1,003,000 on our books. We take the receivable off our books. We exercise our option, and so we have $1,320,000 worth of US dollars. We take that receivable off our books, and we take that foreign exchange option off our books. So if we're looking at Hoyle's 12th edition of Advanced Accounting, this is the order they treat things. We have an actual asset, an account receivable or an account payable on our books. We can hedge it with a forward contract that locks in our gain or our loss. We can treat it as a cash flow hedge. That's the Mercedes-Benz, because we can solve all the timing differences. Or we can treat it as a fair value hedge, which is the accounting. The debits and credits are exactly the same as any other trading security, except we get to have a special footnote. The only problem with the fair value hedge is that the timing is going to be off. We also could use an option, buy an insurance policy like we just did for $9,000. We can treat that as a cash flow hedge or treat that as a fair value hedge. We could have a firm commitment. So we know we're going to prepare something for a client, but we can't send the invoice because we haven't earned it yet. Well, we can still protect ourselves. We can have a forward contract and treat that as a cash flow hedge or a fair value hedge. The 12th edition of Advanced Accounting by Hoyle does not walk us through the cash flow hedge version of that, but it exists. We can do this so we can have an option, even though it's just a firm commitment. And again, the book doesn't walk us through a cash flow hedge, but it could. Instead, it just walks us through a fair value hedge. And finally, we could have a forecasted transaction. It's probable that we're going to be doing business. We're in the habit of doing €1,000,000 worth of business every third quarter of every year. So we can anticipate that with a forward contract, and we have to treat that as a cash flow hedge. There's no such thing as a fair value hedge for a forecasted transaction, or we could use an option and treat it as a cash flow hedge. And don't forget that if we screw up and we don't meet the 3 tests, if we don't have something to hedge, if we don't hedge it efficiently, and if we don't properly designate it, it's not the end of the world. We're still going to get the debits and credits of a fair value hedge, but without the benefit of a footnote that talks about our hedging abilities and our hedging capabilities. And we won't get to use the cash flow hedge, which we like a lot because it solves all the timing differences. All right, so I hope this makes chapter 9 of the book easier to read.